Well, hello and welcome to Switzer TV. It's great to be back. This is our first show for the year, and we've got some of our usual favourites with their views for investing for the year going forward. Coming up first is Jun Bei Liu. I've asked Jun to look at three stocks that she thinks could be volatile, but she really thinks have potential for real upside over the course of the year. And then Mike Gable will look at a number of stocks as well as the indices to see if the stock market can keep on rising. So without any further ado, let's go to Jun Bei Liu of Tribeca Alpha Plus. Well, welcome to the program, Jun Bei Liu, and Happy New Year.
Happy New Year. Thank you for having me, Peter.
Okay, last year we were pretty positive when things looked pretty grim, and the year started off really nicely. Probably a bit faster than what both you and I were expecting, but it's still good news.
Look, it's fantastic news. We probably seemed pretty silly at the time when the market was crashing and burning, and both of us saying, "Look, this great buying opportunity." Look, it came really fast. It's just market got so bearish on how terrible things will be, and it turns out, look, economy is slowing down, but look, the retail sales are okay. We had a couple of upgrades as well, and then even in the US, inflation seems to be falling, and the interest rate expectations are stabilizing. So net just means people got so bearish that it's really just the flow back of some of the confidence, and that's really good to see to start the year.
Yeah, and I know that the history basically shows us that when interest rates are rising, they get to their top, the economy can really be hurting, but that's when the stock market often takes off because the market anticipates where it's going to be in 6 or 9 months' time when interest rates are falling, and there's ultimately going to be a bit of a rebound for the economy, maybe a year down the track.
Look, absolutely. This is what share market does. So this sometimes confuses some retail investors. And why is share market not reflecting what the underlying economy is? Share market is always, if you like, about 12 to 18 months ahead of where the reality is. So when we are actually in recession, share market is looking forward to next year because next year earning will be better than this year. So right now, we do think the market is trying to look through the near-term weakness. We will have slowdown. We will have earnings downgrade, but a lot of it is being expected. So market is trying to look through. There might be some volatility near term, but the net, I think for this year, market still look pretty good.
Okay. I'd like to ask you as a hard question, the three stocks that you think they might be volatile and they may well disappoint, but if you had to pinpoint three stocks that could really shoot the lights out over the next 12 months, and let me add to everyone listening, this is not your strongest argument, but these are stocks that you've thought about and they do have potential for upside, big upside.
Look, absolutely. So two of them we talked about before, and in my view that you should definitely have some in the portfolio and buy on more dips. So number one is Xero. Now this company gone through pretty tough times because it was an expensive growth company, but incredible track records. Now because of it's got a good exposure, big exposure in UK, and because of slowdown in the economic activity, everyone's worried about the SME exposure and the like. Its competitor actually reported pretty good numbers, but Xero has been sold off on the back of potential worry for that, for the recession worry for UK. And that business now, Xero is represent incredible amount of value. It may be volatile because it's an expensive company, but our view is that you do not buy this company for the next 6 month earning. You really buy it for the next 5 years. And this company is well on track to achieve the growth targets it's put in place over the long term. So Xero is the one I would definitely have in the portfolio. If the share pulls back, you will buy more of it.
Yep.
Go on to the next one.
Yep.
Yeah, so the next one is we talked about it before, is NextDC. Now this company, again, it sits in that expensive business sort of area simply because it's an infrastructure stock. It needs to keep spending and grow its footprint, and it has increased it has built an incredible amount of network in terms of data center here in Australia, and then the reason share price a little bit weak is because last 12 months it's a little bit it's an expensive basket that's been sold off, and also it hasn't won as many contracts as many expect. Now, our view is that in the next 12 months, the company they started announcing some small contract, and we heard there's a lot more activity in that commercial space. So there's a few contracts lined up, and I think it's coming through. Also, another thing is M&A globally is picking up in that whole space. If you look at globally, some of the M&A that's taken place in the US, in Asia, are very attractive, very good valuations, and we do see potential for a lot of suitors coming to Australia, because as you probably know, Australia is a very unique market. Market power and the market positioning is very, very important for data center as well as many things. So we think NextDC is in that very prime asset sort of space. That is one we would absolutely put that there. Look at the next one, maybe a little bit, perhaps a little bit too contrarian at the moment, but we always think as a high quality company, you should always have it, is realestate.com. The share price sort of lagged, being sold off. People worry about, the listings, double-digit listing decline and things. Our view is that, look, this is a business that deliver long-term growth. Not only listing will drive its earning, it's actually a lot of depth penetration. It's getting more dollar for every listing it's generating on its website, and it has created that phenomenal momentum across its business. Market leader, and it can flex on costs. Most of the costs are variable, and then they have historically demonstrated during tough times they flex costs very, very quickly. We think that this company, look, in the near term, there may be a little bit of weakness across the listing, but we think this business will be able to flex its costs and will do well. And pretty much in 6 months' time, they will be cycling some of those weak numbers, and we should expect that to improve. And if anything, recently we actually have heard spring selling in terms of the traffic through the home viewing and things. It's actually been picking up in some of the markets that have seen large share price decreases. So not share price, house price decreases. So I actually think that real estate market is interesting. Don't throw them out, and don't just say next 12 months there's no catalyst. This is some high quality company you need to put your money in.
Yeah, that's good. That's a good investment strategy, to buy quality companies when the market trashes them. Let me just run through a quick speed dating session of a number of stocks and just say whether you like them or not going forward. First one is Tyro.
I do like it. I think it's in a very good spot. It's got a great earnings growth profile coming through, and then it's got suitors, many interested parties. So absolutely have it.
Yeah, I must admit, I like the ad I saw on TV. The company hasn't been advertising for a long time, so the new CEO is getting that one right. And Megaport.
I love Megaport. It's alongside of the data center exposure. It offers that infrastructure for the company's ability to flex where they have their data exposure and where they need to transfer. It is a stock for the future, and we think it's a must-have for the portfolio.
All right, next one is NextDC, but you've already covered that. CSL.
CSL you need to have. It's very defensive, and earnings going to be pretty good. It will have double-digit earnings growth because of the COVID impact and post-COVID recovery, and it's very defensive for this market. We love it. Okay,
BlueScope.
Yeah, I think that was a little bit hard for me. It is on the value end, and so far the steel production is steel is looking pretty good. But in the face of US economic slowdown, where BlueScope is very much exposed to, as well as slowdown in housing here in Australia as well, I do think it's a tougher spot. It will rally on China reopening sentiment, but to me, it's just a very hard stock to own when the globally most of the economy slows down.
Aristocrat Leisure.
I like Aristocrat. My view is that Aristocrat will have very good, land-based earning. Or the casino has reported very strong earnings, and we think that it's going to do very well. Very well. Only thing is has US dollar exposure, which might mitigate some of its returns.
All right, one last question. The miners have done very well, coal in particular. Do you think resources will still have another good year in 2023?
I think it will, net it will be pretty good. In near term, in the next few months will be a little bit tough, just because, it rallied very hard with the sentiment, and earning might be a little bit of a softness because, in that global industrial production is still a little bit weak, and China still take time to ramp up. So yeah, so near term might be a bit of profit-taking behavior, but over this 12-month, things still looking pretty good for them.
All right, Jun Bei Liu, great talking to you. I'll see you in a couple of weeks' time.
Thank you very much.
And that was Jun Bei Liu of Tribeca Alpha Plus. And coming up now is Mike Gable of Fairmont Equities. But before we do that, I just want to let you know that as of March, to view Switzer TV, you'll have to become a subscriber to the Switzer Report. We'll give you new subscribers. Annual subscriptions will get one free extra month, a free copy of my book, Join the Rich Club, that will actually give you $470 worth of value for only $397 a year. Plus, with the Switzer Report, you'll get 3 weekly newsletters, stock and investing insights straight to your inbox every Monday, Thursday, and Saturday. Q&A forums on Thursday at lunch. We call that the Boom Doom Zoom show, where you can ask any question, either by text or by turning on the mic about any stock you're interested in. You're having your investing questions answered by our experts, and these will be written out answers if you put them to us. Regular webinars. There'll also be various events over the years which you'll get complimentary tickets to, including ones that have showcase new products and really interesting investment ideas from some of the experts around the country. Plus, you'll get access to resources on the website, and you'll see all previous Switzer reports that we've put out over the last near decade or so. So you get all of this for $397 a year, plus you'll get this TV show as well, and people who aren't subscribers won't be able to access it. So keep that in mind and go to switzerreport.com.au, and don't forget to sign up. It really will be worthwhile. And for many of you investors out there, it will be tax deductible. So without any further ado, let's now catch up with Mike Gable of Fairmont Equities. Well, joining us now is our charts guy, Michael Gable from Fairmont Equities. Michael, Happy New Year, and thanks for joining us.
Thanks, Peter. Good to be back.
Yeah, so let's kick off with a real driver of our stock market, Michael, namely what the US market might be doing. So let's kick off with the S&P 500. What are the charts saying there?
The US market, it's at a fairly crucial point at the moment. So I think at the moment we don't have a lot of clear direction, but I think by the end of this week we'll have a bit more of an idea as to whether it can continue higher or not. So yeah, as a bit of a recap as to what's been happening recently, we've got the daily chart here of the S&P 500. What I've spoken about previously on the show is the 200-day moving average, which is a major resistance level, and that's indicated by the squiggly blue line. And I've also put a straight blue line here to show the downtrend that the S&P 500 has been in over the past year. So in terms of when we last spoke, Peter, we got a bit of a sell-off under that key resistance level at the end of December. But as we all know, the market's done really well so far this calendar year. And where the S&P 500 finds itself now, it's just managed to crack these key resistance lines. However, it is still sitting under these peaks from November, December. So I think it's at a crucial level here. Can it hold above the 200-day moving average and continue higher? Or is it going to see some selling and get back into the range? And I think this week's key, not only because of where it sits, but we do have the US Federal Reserve most likely raising rates in a few days' time. Is it 25 basis points? Is it going to be 50? What commentary will we get along with that rate rise? So potential volatility later this week. The bull case is if we could hold above the 200-day and preferably just cool off a bit and absorb some of this move, then that sets us up for a nice rally higher. Otherwise, if we do dip back under these blue lines, then we're looking at further softer levels for a period of time. I mean, I can't predict what's going to happen. I think probably there's a little bit more than a 50% chance that we do end up back here into the range and drift sideways for a bit. But yeah, we'll know a bit more in a few days' time.
Yeah, the Federal Reserve may well be a bit jumpy about the excessive positivity. But as you point out, we're still not really shooting the lights out in terms of the track record for the index. And so you're right. The narrative that comes out from the Fed is going to be really important. Well done. Let's go to the Nasdaq, which has really had an impressive start to the year.
Yeah, so with the Nasdaq, similar chart to the S&P 500. So it's had a bit of a run back up to the 200-day moving average. Yes, it is above it at this point in time, but generally, whether you're a few points above or below, we could safely say it's sitting around that resistance level. And again, this could be a turning point for the Nasdaq. The index doesn't look as strong as the S&P 500, and the reason why I say that is because it did pull back a lot deeper in December. So where the S&P 500 was sort of more up here, the Nasdaq has had a bit more of a scenic route. It has gone back to retest those October lows. So you've got this V shape here. I think you need a bit of selling, a bit of consolidation just to absorb some of this price action for the bull case for there to be a sustainable rally from here. I think a nice consolidation will be good. Otherwise, if you get a sharp reversal from here, then you'd be hoping that these support levels hold.
Okay. I must admit, Michael, I've always liked the fact that whenever there's been some really good news for tech companies, I think Amazon went up 12% one day, Tesla 8%. Companies like MP1, Megaport, have had good days. So I think once eventually the tech sector in America is out of the woods, some of our better tech companies will have a nice run, but that's all out there waiting to happen. Let's go to the ASX 200 index. I presume there's a bit of a similarity with those other two indices.
Yeah, our market, especially in the last few weeks, it's really detached itself from the US. We've really kicked on a lot more than what the US market has done. So where the US market is potentially just breaking its downtrend, for our market we just have this huge sideways, just basically chopping action over the past 12 months. Very tricky price action here. I think it looks a little bit vulnerable up here, and the reason why I say it is when you get a pullback like this, to get a V-shaped recovery to this extent is a bit unusual. Often when you get a V-shaped bounce, it either gets sold into pretty sharply, or it pulls back and gives you a higher low. So for example, where we had a V-shaped bounce here, the market pulled back and you got a higher low, so you got a chance to buy into it, and we could see that on a number of occasions. Usually when you get, if it doesn't do that, then for example, we could see the V shape here resulted in a large sell-off. So what's unusual about this is ordinarily you'd get a V-shaped bounce, and if we were going to be bullish and if it was a buying opportunity, you'd get a bit of selling. The market holds up, doesn't go back too deeply, and then you've got a buying opportunity. What's unusual about our market is it's just been relentless since the start of January. It's been up almost every day, which is a bit unusual. And what it also shows is that the sellers haven't stepped up to the plate yet. So ideally, you want to see some selling. You want to see the buyers match the selling. Markets don't go down too much. Then when the sellers are out of the way, you can get a sustainable move after that. Whereas I think a move like this is fairly unsustainable. And I think if I had to get off from sitting on the fence, I'd say most likely from here, you'd expect a bit of a pullback. So, ideally, if markets can pull back to slightly lower levels and hold in, then you're setting yourself up for the next move. But I wouldn't be chasing a move like this. Because as I mentioned earlier, once January's over, once the US Fed Reserve raises their rates, you've potentially got a catalyst there for a bit of a cooling off. So I think we could be patient for a few days on our market as well.
Yeah, there's also US job numbers at the end of the week, and they could be a plus or a negative for the market as well. Let's go to some individual companies. Let's go with Tyro first. It's got a company wanting to take it over. There's talk that Mike Cannon-Brookes might be sympathetic to an offer. Around $1.80 might be the price that he might say yes, he's a major shareholder. I think a lot of people would be cheesed off if he did. But let's just have a look at what the charts are saying about Tyro.
So with Tyro, as we could see, it had a back half of last year, nice recovery, and along the way we've seen the low points get higher and higher as the buyers have stepped in. But then at the start of December, this chart in terms of the last several weeks, it is dominated by this big sell-off. So what you had was another pullback, but instead of finding support at the prior low point, it actually went under it, unfortunately. So it's tried to bounce, but as we could see, it managed to fall from about $1.80 to $1.20 in the space of a week and a half. And then in the space of a month and a half, it's only been able to retrace half of that fall. So it is showing signs that this rally is, for the moment, it's over. I think it's looking a bit tired. It needs to, I don't expect it to go up too quickly for the moment. The fact it's held on to here is a positive, but I think it'll just use some more time drifting sideways before it's going to get going again. At the moment, it looks like there's a bit of a ceiling around $1.60.
Yeah, and that's the price that potential capital has put on the table. What I find interesting about Tyro is that it's a payments company, and they're on the outer. It's also a tech company as well, and that's on the outer. I'm sure potentials of prepared to pay $1.60 on the belief that in a year's time, that share price will be over $2 once tech and payment companies are a little bit more in favour. But that's just my personal view, and I guess I'm talking through my pocket as well. Let's go to the next one. MP1, a company that I've always liked, but it's had a big sell-off. I particularly like it since it's been sold off. Mike, what are the charts saying?
So I think this one's still building a base. So the stages of this chart, the left-hand side downtrend, then it looks like the downtrend was sort of broken sort of mid to sort of third quarter last year. And then we've just got this sort of large base building, which is basically the shares moving sideways. I wouldn't call this a trend. So it's no rush to get into it. When we zoom into the shorter term price action, you do have some of these large sell-offs here, which is a little bit of a concern. I mean, when you look under the hood of the base that's getting built, it'd be nice to see sort of sharp moves up and a lot more sort of sideways consolidations. But we do have some sharp moves. A little bit of a concern, but if we zoom out from the short term, as I said, it's just base building. So on a positive, downtrend appears to be over, but just not trending up yet. So we're not at that stage yet.
Yeah, and I think it's a company that needs the US tech rebound to be more consolidated and more convincing. NXT, NextDC, good company, has been on the outer for some time, but all the analysts really like it. I know I did a bit of a review from FN Arena, and they really do like the company. But what are the charts telling you?
Yeah, this chart is a bit more negative than the last two. At least the other couple of tech stocks had stopped falling and just needed to move sideways for a bit, build a bit of a base. This one does look like it is still in its downtrend, unfortunately. So I'm not seeing any signs yet that this could be the ultimate low. It does look like it may even go lower. So when I look at the way this is trading, just at first glance, I could see very sharp moves down every time it tries to rally. It takes a while, but when the sellers get involved, it does move pretty swiftly. So it's not a good sign. And most recently, we had this big reversal day here. So this red candlestick, the shares opened higher on this particular day, but by the end of the day, they were well down. And I don't have volume on this chart, but volume was quite high on that day as well. So it started to recover, but now it's back to where it started that most recent sell-off. So I think it's at risk of coming back again. For this, I don't think it's going to go up anytime soon. At best, again, you'd start to get a bit of a sideways movement, a bit more of a base build, like what Megaport's doing. But unfortunately, this one to me is still in that downtrend phase.
Okay, let's go to a healthcare company in CSL. Often healthcare companies are seen as being defensive, but CSL has behaved like a growth stock and basically fell during the coronavirus period when the tech companies were selling off. Started to make a bit of a recovery last year, but what's the chart saying now?
Yeah, so this is a weekly chart, so we're going back about 6 years. As you say, during the drop with COVID, it has underperformed. So CSL has been an underperformer for a couple of years, but prior to that, it's done really well. So over 2019, it returned about 50% as we went into that rate cutting cycle. So it is sensitive to interest rates. So I think a pause in interest rates and possible interest rate cuts at the end of this year, early next year, will be a positive for CSL. It's had its few moments recently. There's been some weakness in the healthcare sector over the past 12 months on and off. So even sort of end of last year, there was a bit of a sharp sell-off. But if we zoom out, to me this pattern actually looks quite bullish, because we had a very nice run up there a few years ago, and even though it hasn't done anything in the last couple of years, to me this just looks like one big sideways consolidation. So when we're looking at some other stocks, and you get a bit of a run up, and then they might move back for a little bit for a few weeks, or go sideways for a few weeks or so. CSL's been doing that for a few years, which is actually a good sign, because a general rule of thumb is when a stock finishes consolidating and gets back into an uptrend, the longer it's consolidated, the more powerful the move you get afterwards. So in other words, if a stock just moves sideways for a few days or so and consolidates, you might get a rally for a few days. If it consolidates for a few months and then it breaks out, you might get a multi-month move. This is a multi-year consolidation, which means if CSL can get out of this range, then you might have a good move higher for a few years, and you may well see a 4 in front of CSL's share price. So longer term looking bullish. In the short term, very volatile, and I think ultimately what you need to see is a push above $300, and I think it needs to stay there for a few weeks, and then you could start to get excited about CSL being an opportunity again.
Okay, mate. Let's go to a company that had a nice run, but a few question marks over it now, named BlueScope.
Yeah, so BlueScope, so it looks like we've got the downtrend. It's starting to get into an uptrend, which is a positive. The negative thing about this stock is, you might not be able to tell from this chart, but it's very volatile. So you get these very, very large daily movements, and what that means is it's easy to buy. If you buy BlueScope after a few days up, it's easy for you to be down several percent a few days later, because it just moves so much, and then by the time you realise it's starting to downtrend, you've lost quite a bit. So I think it's a very difficult stock. Even most recently, we could see it being very choppy. It's in a bit of an uptrend now. I think the way to play this is you need to wait for a dip, and if it can give you a higher low, that might be the better entry point than trying to chase it up here. So probably better to wait for a dip and keep your stops fairly close by.
Yeah, and I must admit, I had a good look at what the analysts are saying, and none were excessively excited. Probably out of 6, there might have been one seeing a 20% gain, but there was a lot of analysts thinking it would fall, others thought small rises. There was nothing convincing about what I saw when surveying the analysts. Let's go to a company that you've liked in the past, namely Aristocrat Leisure. What's the news there?
Yeah, I did speak about this one a couple of months ago, and unfortunately it hasn't done very well, and I don't like the way this is trading anymore, to be honest. So we had a situation where you had this downtrend followed by what looked like a very slow uptrend. But then the sell-off, it started to come back in December, and it really started to accelerate, breaking that support level. So most recently, bad performance at the end of December. It's bounced just like the whole market has in the last few weeks. But again, we've got this sort of, I think, a bit of an unsustainable V-shaped move, and now it's back in the region of that old, what used to be an old support line. So if the selling kicks in here, and so far looking at the last couple of days, it has been struggling, we may well see lower levels for Aristocrat. So yeah, look, at the moment the chart is, it is looking fairly weak, and I think if you're looking to buy Aristocrat, if you're still looking to do that, just hold off. I think you can get it cheaper at this rate.
Yeah. Okay. Let's go to the one I always ask you to pick out one that you think is looking promising, and this time it's Fortescue.
Yeah, so at the moment, to be honest, with the market as sort of toppy looking as it is, and the risks that we have this week, I wouldn't be rushing out to buy anything today. So I thought I'd pick a stock I like that is likely to pull back and give us another opportunity. So I've spoken about Fortescue before. As we could see, it had a very nice run up across November, December, but price action over the last couple of weeks, I think it's quite interesting to see what it's doing at the old high. So we had this run up in early January. It touched the old high that we could see all the way back there about a year ago. Pulled back, which is natural, but then on the second attempt to go to a new high, I can see last Friday it was up quite strongly in the morning. It was up over 3%, but by the end of the day it was almost flat. And today we could see it down again. So it's showing me that there is a bit of a brick wall at the moment for Fortescue, and I'd expect it to come back closer to the levels near $20. And it's interesting, these stocks, because back when we had this big reversal here and the buying opportunity in November, there was a lot of bearishness around iron ore being back to its 12-month low, and China never, they won't abandon their COVID zero policies, etc., etc. And before you know it, that marked the low, and it rallied. But I've noticed over the last couple of weeks there have been a lot more bullish, bullish stories on iron ore. So I think it's probably run too hard, and it's a good chance to exit up at these levels, and we can come back to it over the next few weeks, Peter. But I think it might bottom out around $20, and that might give us a new entry point. Okay, so what you're saying, the people who got on your Fortescue train, they may well be advised to take a bit of profit. Yeah, exactly. We've taken profit on Fortescue as well, and yeah, I'd be looking to get back in. And at the last show, Peter, I was talking about gold. I know a few people have been wanting me to keep everyone updated, because there seems to be a few people trading gold. I think gold's still looking good. The gold stocks like Newcrest and Evolution looking a bit shaky the last couple of days, but I think there's still opportunities there as well on any dips. All right. Well, next time I get you on a couple of weeks' time, we might have a deeper look at gold. I know a lot of people are interested in the gold bar right now, so we'll do that next time on the program. Thanks for joining us, Mike. Sounds good. And that was Mike Gable of Family Equities. Thanks for joining us on the show. We'll be back next Monday. Thursday shows are no longer a part of the furniture. We're doing blockbuster shows on Monday, and I look forward to seeing you then.